In the realm of decentralized finance, DeFi, envision a world where trades, savings deposits, and insurance purchases occur seamlessly, all without intermediaries such as banks. DeFi, an umbrella term for a spectrum of financial products leveraging blockchain technology, has garnered billions in funds. Proponents foresee it evolving into a formidable industry, challenging conventional financial institutions. However, the crypto winter of 2022 laid bare vulnerabilities within DeFi. Several billion-dollar projects collapsed, and investors suffered significant losses to cyber criminals exploiting platform weaknesses. So, what precisely is DeFi, and does it genuinely stand a chance at reshaping the future of finance, or is it a dead end? The term DeFi, short for Decentralized Finance, originated in a 2018 group chat on Telegram. It emerged from brainstorming sessions among software developers aiming to christen a network of financial services built atop blockchains, eliminating the need for intermediaries. Unlike traditional finance, where centralized institutions like banks manage and store funds, DeFi bypasses these entities. Instead, new infrastructure is being erected, removing banks and intermediaries from the equation. With DeFi, individuals can develop and launch financial services on a blockchain with minimal barriers to entry. Carol Alexander, a finance professor in the UK, closely monitors blockchain and cryptocurrencies. She highlights how even small startups with limited resources can partake in DeFi, offering services such as crypto interest accounts or peer-to-peer lending. One of the most prevalent applications of DeFi lies in lending. Users can lend out their cryptocurrencies, akin to traditional lenders with fiat currency, and earn interest. Alternatively, they can borrow funds by pledging their tokens as collateral, with interest rates dynamically adjusted based on loan demand. In the world of DeFi, exchanges are governed by smart contracts, coded agreements on blockchain networks, typically Ethereum, that execute automatically upon meeting specific conditions. This proliferation of digital financial services ensures swift fund transfers, drastically reducing settlement times compared to traditional banking methods. Unlike conventional systems reliant on intermediaries like SWIFT, DeFi transactions occur without a central authority, facilitating near instantaneous transfers. The true essence of blockchains lies in serving as the infrastructure for Web 3.0. They act as the motorways, with smart contracts akin to cars. Various blockchain networks cater to different applications. For instance, non-fungible tokens, NFTs, represent a specific vehicle type. Each blockchain's associated cryptocurrency, like Solana's SOL or Ethereum's Ether, serves as the fuel propelling these transactions. Despite DeFi's exponential growth in 2020, its unregulated nature poses risks, as protocols lack consumer protection. Concerns also linger regarding the decentralization of DeFi platforms, with regulators cautioning about potential governance by influential entities. Dubbed the Wild West of crypto, DeFi has enticed investors with promises of high returns, yet it's not immune to exploitation. Reports reveal staggering losses due to scams and thefts, underscoring the urgency for regulatory scrutiny. At a London conference uniting crypto companies and regulators, discussions revolve around cleaning up the crypto industry. As blockchain encroaches on traditional finance, combating DeFi-related crimes becomes paramount. Gervais Grigg of Chainalysis emphasizes that while DeFi and blockchain aren't inherently malevolent, the influx of funds inevitably attracts criminals. Jim Lee from the IRS echoes this sentiment, highlighting collaborative efforts to tackle DeFi-related illicit activities. Collaboration between the crypto world, DeFi, and government agencies is paramount in combating financial crimes. With hundreds of crypto-related investigations underway in the U.S. alone, the speed at which crypto transactions occur necessitates global partnerships to stay ahead of criminals. These collaborations shrink the space for illicit activities, ensuring a stable ecosystem in an increasingly interconnected world. Just like a car relies on various components working flawlessly, every DeFi service is the result of human labor, prone to imperfections. Errors within DeFi mechanisms, such as blockchain bridges, can prove costly, with sloppy programming leading to vulnerabilities exploited by attackers. In 2022, losses exceeding $1 billion were incurred due to bridge exploits. However, advancements in software tools enabled better tracing of illicit gains. The transparency and speed of blockchain records accelerate fraud investigations compared to traditional finance. While the DeFi market has grown to over $60 billion, it still trails behind traditional financial institutions holding trillions. Incidents like the Terra stablecoin venture's collapse have dampened investor sentiment, highlighting DeFi's infancy and the prevalence of scams. However, investments in enhancing platform security and forthcoming regulations aim to weed out bad actors and safeguard investors, paving the way for DeFi's maturation. As the industry evolves, eliminating cowboys and corrupt practices is crucial for realizing DeFi's potential in addressing wealth inequality across generations. Centralized Finance, CFI, and Decentralized Finance, DeFi, represent contrasting approaches to managing cryptocurrency transactions. While CFI operates through centralized exchanges akin to traditional banking, DeFi leverages decentralized platforms to facilitate transactions directly between users. Both approaches share the goal of enabling cryptocurrency use, but differ in their operational frameworks and implications for security and control. Choosing between centralized finance, CFI, and decentralized finance, DeFi, depends on individual preferences, risk tolerance, and specific financial goals. Both approaches offer unique benefits and drawbacks, making it essential to weigh them carefully. CFI provides conveniences like margin trading and interest income, but requires users to entrust their funds to centralized exchanges, potentially exposing them to custody risks and regulatory compliance issues. Additionally, accounting is managed by third parties rather than through transparent smart contracts. On the other hand, DeFi offers a peer-to-peer approach, granting users full control over their funds through private keys and executing transactions via smart contracts without relying on centralized entities. This model ensures custody of funds, grants anonymity, and typically incurs lower fees. However, DeFi presents challenges such as complexity, reliance on sophisticated algorithms and smart contracts, susceptibility to attacks, volatility, and the absence of human customer support.